Indirect rates are computed by accumulating costs by cost pools, which are numerators, and cost bases, which are denominators. For this episode, we will focus on the impact of your ceiling rates. Typically, a contractor can recover all allowable costs subject to the contract limitations, such as award amount, period of performance, flexibility of rebudgeting, etc. However, another contract limitation is the simple but dreaded ceiling rate. Ceiling rates exist to help minimize the risk to the government. In addition, ceiling rates provide an easy avenue for contractors to request indirect rates in proposals. The most common ceiling rates are SafeHarbor rates, and they may exist depending on each agency. The less common are ceiling rates included to minimize risk to the government due to the contractor's accounting system or cost containment. For example, ceiling rates for the National Institutes of Health have two levels. The first level is a SafeHarbor rate, where NIH will give you an indirect rate of 40% for FNA indirect costs without required substantiation. It is important to note that if your award includes an FNA rate of 40% or less, you will be bound by the lesser of two rates for the duration of the award. Once you know your direct costs and your ceiling rate, you can then determine what to bill the government. For example, if you spend $1,000 on direct costs with an FNA rate of 40%, you would bill the government $1,400. $1,000 of that will be to cover the direct costs and $400 to cover any indirect FNA costs. If you should propose an FNA rate of 35% and your actual FNA costs are calculated at 30%, you will have billed the government for 35%, but then you would owe the 5% difference upon closing the grant, unless the remaining costs have been absorbed by direct costs. The second ceiling rate structure for NIH is a ceiling on negotiated indirect rates. In other words, if you need to negotiate an indirect rate higher than the SafeHarbor rate, let's say 50% FNA rate, NIH will then enter into a formal negotiation where you will be required to provide historical and prospective data supporting your request. When NIH issues your rate agreement, and you are successful in billing the government at 50%, NIH will most likely have a 2 or 3% ceiling on the 50% to limit their exposure. For example, if your company incurs FNA costs that equal 57% and you bill the government at 50%, you will be limited to the ceiling rate of 52 or 53%. This varies by contractor. This is why it is wise to understand your company's projected cost structure prior to requesting rates. NIH is just one example. Other agencies may or may not have a SafeHarbor rate, such as NSF, which has a SafeHarbor rate of 50% of direct salaries and wages, while the Department of Defense does not have a SafeHarbor rate at all. It is important to keep in mind that any costs not reimbursed by the government must come from another source, such as profit, internal funds, borrowing, investment, and other sources. Therefore, it is critical to be mindful of your indirect rate structure, especially if you operate in an environment where you have multiple awards with multiple rate structures for multiple federal agencies. Your company needs to determine whether or not a company-level rate structure makes sense for efficiency and practical purposes, although some of this strategy may be predicted on the awarding agencies. Doing business with the U.S. government becomes challenging at times. However, you should never lose sight of the fact that you're a business first and the government is just one of your customers. At Mocher CPA, we help businesses understand the complexity of government contracting as well as the challenges of commercializing research. Please visit mochercpa.com for more information on how we can help you.